borrowing surge among sub-Saharan African nations has really taken off over the last few years, yet the easy, fast cash sovereign bonds offered to satisfy budget deficits could be on its way out as the Fed mulls over a rate hike. Local currency debt markets will equally share a burden as they rely less on foreign wealth. Here to share insight on the way forward for Zambia, Dr. Samir Gadio. Now in June, the IMF, of course, was reporting that the country's fiscal gap for this year would be 7.7%. Now we're talking about one of Africa's largest copper producing nations, doctor. So how do you think a slump in mining royalties is going to further exacerbate the country's ability to reduce its deficit?
There was an interesting trade-off this year in a sense. The government had to please the mining companies so that there is at least some sort of incentive to invest in the mining sector. Hence the reduction in royalties, but at the same time that has fiscal implications, which explains why we're going to have a much wider deficit this year. The initial expectation was 4.6% of GDP. And in fact, when you look at S&P's forecast, it's minus 10% of GDP. So, you have a wide range. At the same time, you have power shortages that also will probably impact production, and the copper price obviously is in free fall at just about $5,000 a ton now. So all that clearly creates quite a difficult macroeconomic environment. And the recent Eurobond issuance basically reflects this need for external funding given the wider deficit.
Now, Moody's has reported more fiscal deterioration in the last quarter. The B1 government bond rating was reaffirmed, but added to that was an outlook that shifted to negative, the cause being deteriorating debt metrics, as well as a trend of missed fiscal targets. Now, to me, this sounds like a government that is stuck in this self-perpetuating debt cycle. Tell me, what is that going to do to investment prospects?
Well, that's an issue because a few years ago, Zambia was perceived as a country with relatively adequate debt metrics. It still has relatively sustainable debt metrics so far, but if you continue to borrow at that pace in the external market by issuing Eurobonds virtually every year, and if you pay more than 20% on your local debt, very quickly, the debt stock is going to become unsustainable.
Now, last year's Eurobond offering, which hit the $1 billion mark, was oversubscribed 4 times and had a rate of 8.5%, right? But we know that there's this keen interest in African sovereign bonds, right? But has this hunger sort of started to die down?
I think it's starting to slow down. If you look at Eurobond issuances in previous years, it was typically heavily oversubscribed. There was a lot of liquidity. The market was bullish on risky assets. And just because of the funding costs this year, we've seen much less sub-Saharan African issuance and a lot of differentiation. So a number of countries really are perceived as increasingly risky. And as a result, I think the appetite has declined. And if you look at Zambia's Eurobond issuance this time, yes, it was oversubscribed, but not significantly. And that clearly weighted on the pricing.
And when we talk about lending nations, we're not talking about, the IMF and other institutional lenders who would necessarily be willing to write off these debts. We're talking about people who are going to hold the country increasingly accountable for the loans that have been made to it, right? So really, what is that risk and how can the government sort of transcend this difficult period?
It's really a big trade-off for most African countries. On one hand, they need to build their infrastructure base because without this, they won't be able to develop properly and diversify their export base over time. On the other hand, that comes at a massive cost. So you have very large or widening current account deficits in some cases, fiscal deficits and so on, which have to be financed increasingly from the external market or at very high yields onshore. But I think, over time, the market will probably penalize countries which have these kind of imbalances and reward the countries that have tried to push through structural reforms and maintain relatively adequate ratios on the macroeconomic side.
Okay, but how much of the problems that sub-Saharan countries, even Cote d'Ivoire in its past has faced, has to do with the commodity instability, right? So they're hampered by the marketplace as much as anybody else, inside and outside of the continent.
That is true. Having said that, the countries that at least have a diversified export base are probably better off. I mean, if you rely on only one commodity, which could be copper in Zambia's case, or oil in Nigeria and Angola, then you're really very, very sensitive to the global commodity cycle. Now, if you produce, say, cocoa, a little bit of oil, coffee, and so on, perhaps, it could be a difficult period, but at least you can withstand the shock to some extent.
What do you see coming for Zambia in the years ahead?
Right now, I think the market is somewhat concerned that because there is an election in October 2016, it could well be that any attempt to consolidate public finances could come under pressure because obviously the authorities will be under pressure to perhaps increase wages or boost recurrent expenditure. Now, it's not a given, but that's a risk. The other concern is that there is no IMF deal. And it's unlikely to materialize before the elections. So if you look at the countries with very wide fiscal deficits, depending on where Zambia ends this year, because we don't really know what the figure will be, but say if you compare it with Ghana, for example, the market seems to have turned a little bit more constructive on Ghana, despite the very wide twin deficits, because there's an IMF deal there and there's some sort of visibility on what's going on. In Zambia, it's a little bit difficult to read the outlook. And so I think this uncertainty will persist. Now, the risk is that next year, once again, we have a large funding gap and eventually the government is forced to borrow from the external market. But given the current funding cost, that's going to be extremely expensive, especially ahead of an election.